As audit season approaches for calendar year entities, it's crucial to understand key concepts that auditors focus on, particularly materiality. This guide will help you navigate materiality in your upcoming financial statement audit. Materiality determines what's significant enough to include in your financial statement. It's based on the principle that the omission or misstatement of an item could influence a reasonable person's judgment. While U.S. auditing standards and GAAP focus on the probability of changing judgments, IFRS considers whether misstatements could influence economic decisions of users. Auditors use professional judgment to establish materiality thresholds, considering factors like size, industry, internal controls, and financial performance. Auditors may inquire about significant changes, like a 30% increase in shipping costs. Businesses should be prepared to explain these variations and provide relevant documentation. Materiality also applies to non-financial matters, such as sustainability and fair labor practices. These areas increasingly impact the decisions of a broader range of stakeholders. In today's environment, stakeholders extend beyond investors. They include customers, employees, and suppliers, all influenced by both financial and non-financial information. Materiality is a gray area in financial reporting. It's important to work with experienced professionals to determine the right threshold for your audit. Understanding and preparing for materiality in your financial audit can lead to a smoother process and more accurate reporting. Let's ensure your business is audit ready.